Every 4 years, Bitcoin has followed the same pattern. The halving happens, supply gets cut, price pumps to a new all-time high, and then, boom, a brutal bear market crash. This cycle has been so reliable that traders and analysts have basically built their entire careers around it. But here's the big question in 2025. Is the famous Bitcoin 4-year cycle finally broken? With Bitcoin ETFs approved, billions in institutional money flowing in, and Bitcoin hitting new highs much earlier than expected, some of the biggest names in crypto are saying the old rules might not apply anymore. So in this video, we're going to break it down. What the Bitcoin cycle is, why people think it might be broken, what top experts are saying right now, and most importantly, what this could mean for you as an investor. Stay tuned, because this could change the way you look at Bitcoin forever. All right, let's start simple. What exactly is the Bitcoin 4-year cycle? It all comes down to one thing, the halving. Roughly every 4 years, the reward that miners receive for creating new Bitcoin blocks gets cut in half. So, what this means is that the flow of new Bitcoin entering the market slows down, and it's just basic economics. If you have less of something, but the demand for it stays the same or even grows, the price is naturally going to go up. Historically, here's what happens. After a halving, Bitcoin usually enters a bull market. About a year later, it hits a new all-time high. Then the hype fades, the market crashes, and we enter a bear market. And finally, Bitcoin bottoms out, trades sideways for a while, and then the next halving kickstarts the cycle again. We've seen this play out 3 times already. In 2012, halving, bull run, crash. In 2016, halving, bull run, crash. In 2020, same story. And in April 2024, we had the most recent halving. So if history repeats, we should now be in a cycle that peaks in late 2025, followed by a nasty bear market in 2026. That's the theory. But 2025 feels different, and here's why. There are a few big reasons. Reason 1, ETFs changed the game. In January 2024, the US finally approved spot Bitcoin ETFs. That means everyday investors, pension funds, and even huge institutions can buy Bitcoin exposure just like they would buy a stock. Billions of dollars flowed into these ETFs almost immediately, and that kind of demand didn't exist in previous cycles. Reason 2, Bitcoin hit highs early. Normally, Bitcoin doesn't break its old all-time high until about 12 to 18 months after the halving. But in this cycle, Bitcoin smashed through its previous high of around $69,000 just months after the halving, faster than ever. Reason 3, macro factors. In past cycles, Bitcoin was mostly driven by retail speculation. But now, things like inflation, interest rates, and even geopolitics are having a major impact on the price. In other words, Bitcoin is maturing as an asset. It's moving beyond the old halving playbook. So, does this mean the cycle is dead? Not everyone agrees, and that's where it gets interesting. Let's look at what some of the top voices in crypto are saying right now. On one side, the traditionalists. Analysts like Plan B, the creator of the stock-to-flow model, argue that the 4-year cycle is still alive and well. According to him, the halving is still the most important driver of Bitcoin's price, and while we might see some timing differences, the general pattern will continue. Then you have people like Benjamin Cowan, who also believes in cyclical behavior. He argues that while the ETFs and institutions bring new dynamics, the halving supply shock still plays a central role, and we're likely to see another peak around late 2025, followed by a correction. On the other side, the disruptors. Arthur Hayes, the co-founder of BitMEX, has been very vocal about the idea that ETFs and institutional adoption fundamentally change the game. In his view, Bitcoin could behave more like gold now, with steadier, long-term inflows, rather than these crazy boom and bust cycles. Mike Novogratz of Galaxy Digital has said something similar. He thinks we'll see less extreme volatility because institutions are playing the long game. That means the days of 80% drawdowns might be over. And then there's Willy Woo, an on-chain analyst, who points out that the data shows a structural shift. He talks about the liquid supply shock caused by ETFs. Basically, Bitcoin is being taken off the market and locked into long-term holdings. This could flatten out the cycle and make Bitcoin's growth curve smoother over time. So who's right? Honestly, it might be a mix of both. But let's dig deeper. Let's look at the charts. In 2016, Bitcoin broke its old high about 18 months after the halving. In 2020, it was about the same. But this time, Bitcoin broke its all-time high just months after the 2024 halving. That's never been seen before. It's a huge sign that institutional demand is accelerating the cycle. At the same time, though, we're still seeing familiar patterns. Price consolidation after the halving, strong accumulation, and renewed bullish sentiment going into 2025. So maybe it's not that the cycle is broken. Maybe it's just evolving. Instead of a simple 4-year rhythm, we might be moving into a phase where supply shocks, institutional demand, and macroeconomic conditions all interact in more complex ways. That makes it harder to predict, but it also makes Bitcoin more exciting than ever. Now the big question, what does this actually mean for you? Scenario 1. The cycle continues. If the traditional cycle plays out, then 2025 could be the peak of this bull run. That means the smart move would be to ride the wave, but also prepare for a potential bear market in 2026. Scenario 2. The cycle is broken. If institutions smooth things out, then instead of one giant peak followed by a brutal crash, we might see steadier growth over the long term. In that case, long-term holding becomes even more powerful. Either way, the takeaway is the same. Don't gamble everything on short-term predictions. Manage your risk, stay diversified, and remember that Bitcoin is a marathon, not a sprint. And here's one more important note. Just because some analysts think the cycle could be broken, doesn't mean volatility is gone forever. Bitcoin is still volatile compared to traditional assets, so stay prepared for swings, both up and down. But before we wrap this up, I want to talk about some of the biggest mistakes beginners make, especially in a market like this. Mistake number 1. Don't just assume this cycle guarantees you're going to make money. Remember, past performance is no guarantee of future results. Mistake number 2. Don't go all in. I know it's tempting when you hear all these crazy predictions, but the golden rule is still the golden rule. Only invest what you can afford to lose. Mistake number 3. Don't try to trade every single move. Trust me, most people who try to perfectly time the market just end up losing more than they gain. And finally, this one is maybe the most important. Don't ever ignore security. Whether the cycle is broken or not, whether you're a long-term hodler or a trader, keeping your Bitcoin safe in your own wallet is always step 1. So, is the Bitcoin 4-year cycle broken? Well, some of the smartest minds in crypto disagree. Traditionalists say the cycle still holds, while others argue we're entering a new phase driven by institutions and ETFs. The truth is probably somewhere in the middle. The halving still matters, but Bitcoin is also evolving into a more mature asset class. For you as an investor, the safest approach is this. Don't obsess over cycles. Instead, focus on building a long-term strategy, managing your risk, and staying educated. Because whether the cycle is alive or broken, one thing hasn't changed. Bitcoin continues to grow, adoption keeps increasing, and the story is far from over.